All right, look, we might get underway. I think those that haven't joined us yet have probably realised that I'm going to be giving my opening introduction, and they've decided that's something they could miss. By way of introduction, my name is Richard Basil-Jones. I'm the CEO of the Australia-UK Chamber of Commerce. A very quick overview of what the Chamber of Commerce does. I've looked at the registration list, and very interestingly, it's a great mix of our member companies and non-members, and that's fantastic to see. So the Chamber of Commerce is essentially an independent member organisation that's here to support companies and individuals that have interests in both Australia and the UK. We typically support those members by way of events through informing, creating connections, providing networks, and providing collaboration opportunities. This webinar is a very good example of the informing part of our role, where we'll take one of our member who's a specialist in a particular area and have them host an event and certainly inform with us with their specialist knowledge. Today's session is maximising UK R&D tax credits. I think it is a safe assumption to say that everyone on this call has a specific interest in this particular topic. Our guest speaker will be Clair Dart, and Claire is from one of our chamber member companies, Alliotts. And just by way of introduction to Alliotts, Alliotts is an independent firm of chartered accountants and business advisors. They're based here in the UK, but they are part of a global network of over 200 firms across the world. So that's it, the short introduction. I'm going to hand over to Claire now. She'll provide her own introduction. But again, we've got a session that is, I've seen the presentation. There is a lot of information to consume, which is fantastic. A copy of it will be available after the webinar, and there will be time at the end for a Q&A. So on that note, enjoy the webinar, and Claire, it's all yours.
Great, thank you, Richard. Hello, everybody, welcome, and thank you for joining. Hopefully this will be of interest to you, and I won't send you all to sleep. So thank you for the kind introduction. As you said, today I have a lot of information to cover, and I think it's all good stuff, and hopefully, things that are going to be useful to help support your business if you're either in the UK or thinking about coming to the UK, and you want to understand the tax reliefs and incentives for your business. So Richard's just given you a bit of an introduction, but let me tell you a bit more about me and our firm. I'm a corporate tax partner. I'm one of 12 partners at Alliotts, chartered accountants, and we're based in London and also in Guildford. We're a firm with around 100 staff across our 2 offices, and we have a speciality in dealing with international businesses, multinational entities, and also inward investment. We also have specialist technology and media teams and clients across all sectors claiming incentives in the UK. So as I said, I'm a corporate tax partner. I'm also a VAT specialist, and I have around 20 years of experience in practice. So creative incentives are just one element of the work that I do in the tax team at Alliotts. Let me now share my slide. Hopefully you can now all see my slides, because there is quite a lot of information on them, so I'm hoping they'll be useful. 1 second, thank you. Okay, so this is a bit more about me. So I enjoy the complex technical work that I do, but I also like to be practical and help companies make sure they are compliant, but also tax efficient, because that's important in business. So as I said, R&D and tax reliefs are one aspect of the work I do. I also deal with international tax matters and all areas of company tax. I think my USP, correct me if I'm wrong, but I think my USP is the fact I'm pretty normal. I try to make things make sense to clients in a way they can understand. So you might have businesses starting in the UK and they're getting to grips with a whole new tax jurisdiction they've not encountered before. And anyone who's dealt with HMRC in the past can contest to the fact that they have plenty of idiosyncrasies. Or it might be startups where they're venturing into the world of business for the first time and learning all the lingo that goes with it. So what will you actually take away from today? So as we said on the invite, there are a number of things we're going to cover today. We're going to start with an understanding of the R&D tax credit system in the UK. Hopefully you'll have a general idea of it by the end of it, but it is quite complicated. So I don't profess to cover everything in this webinar. We're also going to look at an awareness of the latest rule changes. So there have been numerous changes over the last couple of years, and they keep tweaking it. So there are a few changes to get to grips with in different periods that those changes come into play. We're going to look in detail at the new R&D intensive scheme because this is hugely valuable, especially to a lot of SMEs. So we'll look at that in a bit more detail. We're also going to look at another relief that works hand in hand with R&D called Patent Box, and how that works together. Then I'll cover off in overview some of the other innovative tax reliefs that are available in the UK. There are quite a few of them. And finally, we'll end with a refresher of the capital allowances regime in the UK that remains very powerful. Okay. So let's start with the basics. What is the R&D tax credit scheme? It is an incentive for businesses from the UK government to reward innovation. The economy thrives on new ideas and new innovation to encourage people to venture into the unknown, while they're usually racking up huge costs and most of them don't have revenue for several years. This tax credit can be the cash repayment, which is an incentive to do that and actually embark on that adventure in the first place. The tax credit system works by giving the business either a tax reducer if they are making profits by uplifting their costs that are eligible, or it provides them with cash, actual physical cash, to help fund those costs that they're paying out, especially if they're loss making. So there are strict criteria for the eligibility of the R&D scheme. So the idea of the criteria is to ensure that it's only those businesses that are truly innovating that benefit from it, whereas those that are only really tweaking what already exists and not really advancing anything would fall short. The primary test is to prove that there has been an advance in technology or science, and that in doing so, the advances for the industry as a whole rather than for just your company. So just because you benefit doesn't mean you've advanced technology or science. The other key point is that the advance cannot be readily deducible. So, and by this we don't mean that, you know, one person, a common person, lame person in the workplace could understand it easily. It means somebody actually professional working in that field. So a technical engineer or somebody, if one technical engineer can readily tell you what the answer is, then it isn't research and development. They haven't really had to work on innovating to create something new. How does it work? So let's look at the schemes that we have. We previously had two schemes, and there's been a change in April 24. So we need to look at before those changes and also after those changes. So these schemes we previously had, one was for SMEs, so small and medium enterprises that met the criteria to be small or medium. They could claim under that for the greatest incentive. So they got the biggest reward for their R&D activity because they were smaller. The other scheme is affectionately known as the RDEC. So that's the Research and Development Expenditure Credit. So this is an above the line credit. Colloquially, we refer to it as being for large businesses, but actually there's loads of small businesses that also claim under the RDEC. And that will be the case where, for example, the projects don't meet the criteria for the SME scheme. A common example of an activity that wouldn't meet the SME scheme but could be claimed under RDEC would be where you've had grant funding towards that activity. So there's numerous grants available in the UK, such as Innovate UK is quite a big one. And if you've had that grant funding, you're no longer eligible for SME scheme, but you can claim under the RDEC. So I've just said it's changed. So what we now have is apparently one merged scheme, and that applies from the 1st of April 2024. That replaces the two previous schemes, and it's essentially the RDEC scheme, but enhanced. So it's a merger of the two. However, despite the fact they said we were replacing two schemes with one, we also now have a new R&D intensive scheme. So I still make that two schemes. Okay, moving on to how do we claim? So let's assume we have R&D activity and we meet the criteria. How do we go about making a claim? It used to be a case that the claim was made on the company tax return. You had, therefore, 2 years from the end of the accounting period to submit it. And one of the biggest changes that came in recently is that companies are now required to file an advance notification much sooner to tell HMRC of their intention to make a claim at some point. So essentially, we have to give them a heads up that it's coming. This advance notification applies for periods beginning on or after the 1st of April 23. If it's an entirely new claim, so you've never claimed R&D before, then you have to notify either during your accounting period or up to 6 months after the end of it. So if we say, for example, your company year end is, your company period is the 1st of January 24 to the 31st of December 24, then you'd need to notify them within the 1st of January 24 up to the 30th of June 25. If instead you have made a claim before, then you may not need to notify. So to review this, we look at a 3-year period ending with 6 months after the year end. So looking at our company with a year from the 1st of January to 31st of December 24, we wouldn't need to notify if we submitted an R&D claim in the period from the 1st of July 22 through to the 30th of June 25. If we have made an R&D claim before, but we didn't submit one in that 3-year period, then we'd notify in the same way as a new claimant. We also have a new form called an additional information form, which colloquially, again, we call the AIF. This is essentially a form that explains to the revenue why you're eligible for the scheme. So how you've met the criteria and provides all the details of the claim. The numbers themselves still go on the company tax return, but the AIF is essentially it's an advance notification of why you're eligible to make the claim. So we notify, then we give them the AIF, and then we finally claim. The form also gives the revenue details of your R&D advisor. So you'd fill in who helped you in order to make that claim. Or if you didn't have one, you'd notify that you did it yourself. It's assumed the reason that revenue are collecting this data is in order to track it and identify claims that are the highest risk based on a track record for that advisor. We have been doing AIF for some time now, as it came in immediately in August 23. And the key with it is that it is submitted before the claim is actually made. So if the AIF is not filed, then the claim on the company tax return just won't be processed. It doesn't matter that it's on there, that it will be completely ignored. Prior to the AIF, most companies, certainly reputable ones making R&D claims, people like us, would have made claims and filed a report with that company tax return, which explained pretty much everything that was on the AIF now. So it would go into detail about the R&D activities, how they met the criteria, and explaining why we were therefore eligible. So it gave the revenue that information. It wasn't a requirement, and it's still not a requirement to file a report with the claim, but we still recommend that it's done, even though we're filing the AIF, because it gives them all the information they need to determine that we are eligible, we've considered that we're eligible, and we've concluded that we're eligible. And in a lot of cases, that then prevents an inquiry so that they can just process the claim, pay out your cash fast as possible, and we don't have to, spend that extra time and cost with dealing with their questions. In a way, the AIF has therefore helped in that it provides a lot of the information that was previously put on that report as a requirement. So we're having to answer those questions, and it's forcing R&D boutiques where they may have been, crossing the line a little bit on their claims to actually stop back and take stock and make sure that they are eligible. And the idea is it should cut down on, fraud and abuse of the tax incentives. What we would do is generally still prepare and complete our report that would be filed with the tax return, and we'd use that to fill in the AIF by lifting chunks of it into the form as required, the bits and pieces that they actually still need. The report itself would still be filed because it gives even more information. So once the relevant notifications and the AIF are filed, we can finally submit our claim. And that has to be done on the company tax return as before. All R&D claims have 2 years from the end of the accounting period, therefore, to make the claim. So the usual deadline for a tax return in the UK is 12 months from the end of the year. And then there's a further 12 months after that in which it can be amended. So bear in mind that this does, however, often extend the period from which HMRC can inquire into the return. So you might not want to wait that full 2 years. Okay, so now we turn our attention to now look at who can actually make a claim for R&D. Firstly, it's a tax relief for companies only. So it can't be claimed by partnerships, LLPs, sole traders. It is just companies. The primary factor is the activity must be part of a project with the intention to make an advance in science or technology. And that's the overriding fact. If it's not an advance in science and technology, it is just out, simply. The activity also has to relate to the company's trade. With a lot of these companies, like I said, they'll be racking up these costs at the start. They'll do all the development before they even start to trade. So it might not be a trade that already exists. It could be an intended trade of that company as part of their overall business plan. There are 4 key points that you need to demonstrate to prove eligibility, and you have to be able to demonstrate all 4 of them completely, not in part, not 3 out of 4, but all of them. So primarily, you're looking for an advance in the field. So you are looking to advance some science or technology and to change something that exists already, or to improve something or bring something new that didn't exist. In doing that, you've identified that there are some uncertainties. There's something you're not sure whether you can achieve it or not. There is a hurdle to overcome. There is technology that needs to be created or code that needs to be written that you don't know is possible. Those uncertainties are generally the key thing, and they can be quite hard to demonstrate, especially if you've not documented as you go along what those uncertainties are and where your concerns lie. Because when you look back, it all seems a lot easier than it was at the time, and trying to replicate that information in hindsight is actually very difficult. You also then need to demonstrate how you try to overcome those uncertainties. The key with R&D is that it doesn't have to be a successful project. You have to be aiming for an advance. You have to have identified their uncertainties, and you have to have tried to overcome them. You may not have overcome them, but that doesn't discount the R&D activity itself. But you've got to be able to demonstrate that you tried to overcome them and how you went about it. And it might be you just tried one method to overcome it, or it might be you've done half a dozen. But we need to be able to document exactly how you tried to do it. And finally, like I mentioned before, it has to be something that you couldn't easily work out. So something that a professional working in that field couldn't readily deduce and conclude that actually, yeah, that's how we do it. Because otherwise it really isn't R&D. If we let's look at a simple example. So let's say we have a production plant and you're seeking to work with less waste and more output. To meet this requirement, the engineer for the plant is required to meet new technical parameters. So they must meet an increased speed for the machine. So they start on a project to design a new machine that can operate at a higher speed and that uses less material. Maybe it recycles the waste in some way. The engineer recognizes that it's not obvious to do this and that it may not be possible to achieve. It's not been done before, so there are obstacles to overcome. Therefore, that design for that new plant requires an advance in technology. They've got to come up with something new, and they don't know what the answer is. It's not obvious. They start off with some trials. They prepare a prototype, and then they systematically attempt to resolve the uncertainty as to whether the new machine designed can work at an increased speed and whether waste has been reduced. That would be an eligible activity. There are, of course, some companies that can't claim. And as we said before, non-corporate entities are ineligible. It is only companies that can claim the R&D relief. In addition, companies seeking advances in the arts, humanities, or social science services, including economics, can't make claims. Now we're going to take a look at the new merged scheme in a bit more detail. So as I said, this came in for periods beginning on or after the 1st of April 24. So realistically, we haven't had any of these coming through just yet in practice, except for 1 or 2 short accounting periods. The rules relating to the costs that are eligible remain the same. So none of that's changed. It's all exactly as it was before for the SME and RDEC schemes. But the new merge scheme operates similarly to the old RDEC scheme in that it is a tax credit, and the rate of tax credit remains at the RDEC level of 20% of the qualifying costs. The tax credit generated is the same as RDEC. It is an above the line credit, which is treated as trading income. So if it's treated as trading income, you can understand that it is treated as taxable. To adjust for this, there is a notional tax adjustment at the small profits rate of 19% for loss-making and small profit-making companies, and at 25% for all other companies. There are some ring-fence trades that have some different rates, but these notional tax restrictions are then carried forward as what we call step 2 in the calculation, which is generally accepted to be a pretty complex calculation. But those step 2 amounts can then only be used to discharge a corporation tax liability in the future when the company does eventually make some profit. We're going to look now, as I said, at some of the latest changes in the R&D tax credits. There have been numerous changes over the last few years as the Revenue have sought to tackle the fraudulent use of the incentives, as these incentives really have been abused. The old rules, which continue to apply for periods beginning before the 1st of April 24, have the SME scheme, which provides an uplift of 86% on qualifying costs. So if a company spends £100,000 on R&D activities, instead of getting tax relief on £100,000, the company benefits from tax relief on £186,000, which can either create or increase a loss that can be surrendered for a cash repayment, or it would reduce your profit chargeable for tax. So it would apply as a tax reducer. The 86% was previously 130%, and the reduction was an earlier stage of tackling the abuse. So if the company chooses to go for cash repayment, they can claim 10% of the surrenderable loss, and we'll look at that calculation later, or 14.5% for an R&D intensive company meeting the definition. The 14.5% rate was applicable for all companies prior to April 23. So that's a rate that's also changed. That's been cut back. We also mentioned the RDEC scheme before, which gave us an above the line credit of 20%, and previously this was 13%. Again, looking at some more changes. So there's more than I've already covered. We've also had extensions to the categories of costs that can be claimed. So primary costs claimed on the tax credit schemes are usually salary costs, consumables, a bit of software, some equipment you might use up in the R&D activity, and costs associated with maybe building prototypes. From April 23, eligible costs for R&D tax credits were extended. They now include cloud computing costs and also data sets, which previously weren't qualifying. They've also extended it so that R&D in pure mathematics now qualifies for relief from April 23, and the Revenue have given some guidance on what would be included in that, which is on the slides for you. Another change has been to try and refocus activities to the UK. So to try and bring the activity that's being undertaken and the work being done so that it takes place in the UK. Generally speaking, it means under the new rules from April 24, the activity must be physically carried out here, but there are some detailed rules on it, and there are some exemptions as well. Externally provided workers, that's what EPW stands for, sorry, are now also only eligible where that work is done in the UK and where their salary is paid through PAYE. There are, as I said, some specific exemptions where it can be justified that essentially it was necessary for the work to be done outside of the UK, but reducing the cost base of those activities because you couldn't afford for them to be done in the UK, for example, wouldn't be deemed a decent reason. So that wouldn't be accepted. It would have to be something like deep ocean research and clinical trials that had to take place, obviously, in an ocean. There are also some group considerations in this. So, for example, you might have a UK group that has a branch in another company where they work on the UK R&D projects. If all the IP from the projects is retained in the UK and the profits from the overseas branch are taxed in the UK, the staffing costs of the overseas work will continue to be allowed for R&D. I wanted to cover in detail a bit more on the new rules on subcontractors, which is a little bit more in depth. So, as we mentioned, there were some new changes brought in for subcontractors, which are targeted at companies that are outsourcing all of their R&D activity to countries around the world, but there's no real R&D taking place in the UK. The move is to refocus activities to the UK, or by UK businesses, unless there's a genuine reason for it to take place offshore. The new rules for subcontractors apply for periods beginning on or after the 1st of April 24. So if you have a calendar year end 31st of December, then this would apply from the 1st of January 25. So we've still got a bit of time to do some planning, and you might need to do some planning. The new rules are based around the previous SME scheme, which allowed costs of subcontractors to be claimed as qualifying costs. So where you have a company that is carrying out the contracted out work, they won't be eligible to make the claim. It will be the one that actually instructed that work to be done that's eligible. So because the rules follow the old SME rules, where companies were claiming under RDEC, they're actually now in a better position because these rules allow them to claim those costs, whereas the old RDEC rules wouldn't make them eligible. However, so there's a positive and negative. So there's a positive for people who claimed RDEC. For those who are claiming under the SME scheme, there may be some restrictions now on their costs that weren't there before. So in order to identify whether the costs are contracted out expenditure or not, that's primarily the factor. We need to decide whether they are within the definition that the revenue have given us. This is on your slides, which you're perfectly capable of reading. I don't need me to read out. The key is in that it has to have been intended or contemplated. So this is the final point. The person intended or contemplated when entering into that contract that R&D of some sort would be undertaken. So you have a company in the UK that contracts out its expenses to another company. At the time of the contract, they knew that that other company that was doing it was going to have to do some R&D. And to prove that, actually, it's quite tricky. The idea is that the person making the decision to undertake the R&D, so company A who decided to come up with the innovation in the first place and then got somebody else to do it for them, is the decision maker. And they're the ones who are allowed then to claim the tax relief. So we looked at this in a bit more detail. So HMRC have clarified that intended or contemplated is actually meant to be a very high threshold. They state that it's not enough for the companies to come up with the innovation, for them to think that it's a bit complex, it might be a bit challenging. That's not enough. They'd have to actually really understand what work is involved and show a certain level of technical ability and expertise, not just an understanding that it's difficult. So they'd also need somebody with the specific skills. So if, for example, I was to set up a company in the UK and then to develop an app, I know nothing about app development. I don't know anything about computer programming. And so if I was to contract that out to another company to do it for me, I don't have enough knowledge because I don't have that technical expertise. They would then be eligible to claim the R&D. We'd also need to be able to describe and understand the advances that are being sought and the uncertainties. So I said before, for the criteria, the uncertainties are key. And so we need to be able to understand what those uncertainties are from the outset and not just wait for our contractor to identify and ascertain them and tell us what they are. The key to all of this is that your contracts may need some careful wording. And this is where I say planning could come in. Documenting the process is also important. So if you have a board meeting, say, for example, and you come up with an idea and you discuss how you're going to go about it and you identify what those uncertainties are, that would, if recording the minutes of that board meeting or recording the meeting, for example, or keeping track of emails between parties in that decision-making process will help to prove to the revenue that you did have that intention and the knowledge that R&D was required, because it's quite hard to replicate in hindsight. So we looked in more detail at the merge scheme. Now we're going to have a closer look at the R&D intensive scheme. Firstly, we need to understand what do we mean by R&D intensive. R&D intensive has a definition, which has also recently changed. So for expenditure incurred on or after the 1st of April 23, a company was considered R&D intensive if the qualifying expenditure for R&D constituted at least 40% of the total. For periods beginning on or after the 1st of April 24, this percentage falls to only 30%. There's also a clear distinction in the periods there, which is quite subtle. The 40% rate is for expenditure incurred on or after the 1st of April 23. And the 30% rate is for periods beginning on or after the 1st of April 24. So if we look at our company with a 31st of December year end, the 40% test applies from the 1st of April 23 all the way through to the 31st of December 23 for any claim on the 23 tax return, no matter what that period is. But it would also apply throughout the whole of the accounting period ended 31st of December 24, and it would only change to a 30% test from the 1st of January 2025. There's also a 1-year grace period that allows a company which fails the intensity threshold, perhaps they have like a one-off expenditure or there are fluctuations in the costs and they just dip below the level. But it allows them to continue to claim the intensive scheme as long as they met the intensity threshold before. So this would only apply for accounting periods beginning on or after the 1st of April 24. Looking at your screen right now, you might notice that the rates under this technically new scheme are familiar. And you'd be right, these are the same rates as the old SME scheme, except not all SMEs can now make the claim, only those that meet the intensity condition for enhanced support. So as the intensive scheme is so valuable, I've got some examples for you just to run through them. So starting with some generic examples, so our uplift under the intensive scheme is from 10% to 14.5%. As I said, this is often overlooked, and particularly for periods that straddle the 1st of April 23 date when it first came into play. This is due to the fact that it was effective from the 1st of April 23, but it wasn't actually legislated until the Finance Act of 2024, which became law in February 24. So by that point, loads of claims and tax returns had already been filed, and they hadn't considered this enhanced relief because it wasn't legislated. So these are some of the examples of clients where we've utilised the intensity uplift here. So we had a client with a September year end, and the intensive scheme increased the repayment for the company by £2,000. We had another client with a June 23 year end. We identified an extra £8,000 repayment, and that was a claim that had been prepared by a third party, and we were just entering the figures on the tax return, but we spotted that an intensive claim could be made. And then further, we had a December year end. Again, it was done by a third party. When we were preparing the tax return and entering the claim, we noticed they could get that enhanced relief, and that was a further £20,000. So it can be massively valuable. I've got 2 case studies, which I think we have got time to run through to help explain just some of the numbers involved. So I realise the slides are a bit busy, so apologies for that, but I'll talk you through it. So this is the first case study. So for this one, the client had £443,000 worth of qualifying expenditure under the SME scheme, and that was for the year ended December 23. For the intensive scheme, we've identified we need to split the expenditure. So we need to look at pre and post 1st of April 23 when the rules changed. So that gives us a split then of 109,000 up to the 31st of March and 333,000 in the period up to the 31st of December. We then calculate the uplift. So under the old SME scheme, the 109,000 gets uplifted by 130%. And under the new scheme, we got an uplift of 86%. So we got a total uplift then of £429,000. Then we add those in the next on the right hand side to our qualifying expenditure. So instead of the existing 443 expenditure, we've now got enhanced expenditure of £872,000. Then we need to look at this surrenderable loss that I mentioned earlier. Our surrenderable loss is the lower of the enhanced expenditure, so the £872,000, or the unrelieved tax adjusted loss in the tax comp. In this particular case, there was a restriction because the unrelieved tax loss was £594,000. So we could surrender that £594,000. So then we look at the actual tax credit and how much this really means for the company. So the period up to the 31st of March under the old rules is 14.5%, because that was the SME scheme as it was before. In the remaining period, because we've got the R&D intensive, that's still at 14.5%. So we don't get hit by the cutback in that percentage, which gives us a total repayment claim of £86,000. So that's a cash repayment from the revenue. In this case, we've also got a PAYE cap that comes into play, which I haven't gone into detail because it's complex. In this case, the PAYE cap was 395 grand, so we were able to claim that 86 in full. Some of this information then goes on to the AIF, which I've shown on the right-hand side. And we've calculated the intensive percentage, which is 41.5%, so over our 40% threshold, and therefore it qualifies. If we then look at what it would have been if we hadn't claimed the intensive scheme, the same numbers with our 10% rate on the December part would give us a total repayment of £65,000. So you can see that the intensive claim has therefore produced an extra tax repayment of £20,000. The second case study, and this time we've got a client with £15.5 million worth of qualifying expenditure, so huge amount of expenditure. As before, we split the costs, so we got 13 million up to the 31st of March and 2 million in the period to the 30th of April, so in just that 1 month. We then look at the RDEC. So this is an RDEC claim because obviously they're quite big. In the first period, our rate is 13%, and in the second period, as we said, it changed. It's now 20%, giving us a total RDEC of 2.1 million. We then have to look at the tax restrictions, so that notional tax charge that I mentioned. The first part of the year, old rates of corporation tax, so that's 19%. Second part of the year, it's not a small company, it's a large company, and so the 25% rate applies. And so what we do is we prorate those to give us a prorated rate of 19.49, which is applied to our 2.1 million to give us a tax restriction of 422,000. So the net claimable now under the RDEC is 1.744 million. We look at the cap for expenditure and workers, and our cap here is 1.2. So we got a further restriction of 541,000. So what we can do is claim, therefore, 1.2 million in RDEC tax repayment. That amount can be paid back to us. And then we look at the bits that have been restricted. So we had £422,000 restricted under the tax restriction. That gets treated as step 2, and that gets carried forward to a year when we have profits, and we can then utilise that to reduce corporation tax. We also had a restriction of 541,000 as a result of the workers' cap. But that gets carried forward as well as step 3, and that can be used in the future against either corporation tax or potentially if there's sufficient surplus, we can get it relieved sooner. I said before I want to look at patent box. It's another tax relief on innovation that often goes hand in hand with R&D. And the relief is hugely underutilised, either because the company isn't made aware of it, and then they find out when it's too late, or just generally because it's not understood, it's not widely understood. Patent box essentially reduces the corporation tax rate to a flat rate of 10% on all profits from that patent. So anything from exploiting a patent would then be taxed at 10% instead of the current main rate of 25%. So that's a saving of up to 15% of corporation tax every year for those profits are for the life of the patent, which is usually 20 years. A startup will often have no profits in the first couple of years, and all the costs, so they're losing money, and spending a further sort of 5 or 10 grand on a patent might seem totally illogical when they've got no immediate benefit. Excuse me, but after those first couple of years, maybe they start having a profit of £1 million a year for the next 18 years. And saving corporation tax at 15% in each of those years is then worth 150 grand a year. So with corporation tax rates having risen recently, so as I said, they used to be 19%, they're now 25%, the saving is greater. That 10% rate hasn't changed. So we're now looking at saving 15% rather than 9%, and it's much more valuable than ever. It also works on a number of different patents, not just UK patents. And so whilst usually people will own the patent if they then claim patent box, you also can have an exclusive license for it and exploit it because you're the only one who can. On screen, I've listed for you the countries where you can get those patents registered in order to be eligible for patent box in the UK. Patent box now also requires there to be an R&D activity. So it's a fairly detailed calculation, and what we have to calculate what we know as the R&D fraction. If the fraction is 0, i.e. there's no R&D activity, then there's no claim for patent box. So we need to have some R&D activity in order to make the election. The activity doesn't have to take place every year, though. It might be the company, say, does some activity, makes an invention, then it patents it, but then it uses that patent for the next 20 years without doing any more R&D. It's still eligible for patent box throughout that period because of that historic activity. Patent box is becoming more popular because of the way HMRC are tackling R&D claims, which is making it more difficult for smaller companies to benefit because of the higher level of costs to comply and demonstrate the eligibility for R&D. And all of the advanced notifications obviously adds to those costs and administrative burden as well. Patent box also isn't abused in the same way, certainly not yet anyway. And so the revenue are less likely to make inquiries into those elections than they are for the R&D claims that they know have been abused quite substantially in the past. I'm conscious of time, but fortunately I'm nearly there. I said I would cover off some innovative tax reliefs, some of the other ones that we have to offer, and I'm just going to run through those in overview. There are numerous reliefs available, and they are often very sector specific. On screen, I've listed out a number of the most common ones. Film tax relief is the big one in the UK, encouraging producers to make and film their productions here with an incentive tax credit. Often these companies are pre-revenue, and the tax credit is factored into their budget for their film. There are a number of other different TV and film reliefs as well, as you can see on the slides. Video games relief and the video games expenditure credit is again a common one, which is encouraging video games to be developed in the UK or in the EEA. So in the same way as film, these tax credits are often part of their huge budget for the video game development before it's then taken to market. The new video games expenditure credit essentially replaces the old video games relief, which will end in 2027. And for new productions from March 25. And that expenditure credit came in from January 24. I also promised I would give you a bit of an overview on the capital allowances available in the UK. Capital allowances are essentially a tax relief for expenditure on plant and machinery. So capital items are disallowed for tax relief as general business expenses because that relief is then claimed instead by way of capital allowances. So this is usually things like equipment, office equipment, machinery, business vehicles, vans, lorries, business cars. And capital allowances can be quite complex. And I could probably fill a whole webinar on those alone. So we're only covering these in overview. For capital allowances, we deal with pools of expenditure. We put them into pools. There's usually a main rate pool and a special rate pool. You may then also have some single asset pools for special items on their own. The special rate pool generally splits off costs that get a slower level of relief. So they'll get a small amount of relief each year for the life of the asset. So that's things like integral features in your building that will last for a long time. We've also recently introduced a new incentive to get companies to spend money on plant machinery in the UK, which is called full expensing. Full expensing essentially gives 100% tax relief for main pool expenses, or 50% where these would otherwise be special rate pool items. We also already had the annual investment allowance, which has now been permanently made at a threshold of £1 million a year. So you can spend up to £1 million of equipment and get 100% tax relief. We also have these first year allowances, which again are 100% relief. And these are generally incentives for energy saving or other government initiatives. So you've got the electric cars there and cars with 0% emissions, zero emissions goods vehicles, all the things that the government want you to spend money on, essentially. Then we've got some other things to consider for capital allowances. And a big one here is claims that might be available for bigger projects. So something like a renovation or a refurbishment. These bigger projects don't generally get treated as repairs because they would enhance the value of the building and they're therefore capital. So then we have to look at how we treat those for capital allowances. So there are two ways of going about it. You can either make a claim from the surface value of the cost, just picking out all the eligible items. But if you want to get a better claim or enhanced claim, we work with our surveyor who can attribute even some of the professional costs, which wouldn't ordinarily be allowable on their own, into part of that claim. So it adds to the value of the claim and allows you to claim a much greater proportion of those costs. As with R&D, capital allowances claims have to be made within 2 years. And when you acquire an asset or a pool of assets from another company, then there's also this pooling requirement on any assets by the previous owner. So care has to really be taken when assets are changing hands to make sure the capital allowances position has been resolved. Finally, the point I've got here is on full expenses versus AIA. They seem like the same thing. I get that. 100% tax relief on the asset, yes, in both cases. But there is a distinction. Under AIA, the assets are pooled within the main pool, and then you claim for allowance just reduces that pool, leaving a balance to carry forward. And when you sell it, there's no balancing charge adjustment. With full expensing, they're essentially treated as single asset pools. So that one asset on its own gets 100% relief. But when you sell it, you then create a balancing charge. So it can be beneficial to choose AIA over full expensing. We have now reached the Q&A. We find questions have come in, if there are any. Oh, excellent. I mean, so there were 3 submitted when you registered. So I'll just quickly run through those before handing back to Richard. So the first one was, we've secured a patent protection in the US or UK for next-gen digital infrastructure where AI can be distributed uniformly everywhere, anyone real-time across countries, even when no or weak internet. If we license our IP to Australian companies, how these companies can take advantage of patent box and R&D tax benefits in the UK. So for this one, I'd want to look at it in a bit more detail, but it's certainly possible to take advantage of the patent box and the R&D in the UK for this, as there is a UK patent. On the assumption the UK company owns the rights to the IP, which is licensed to the Australian companies, then the UK company would be exploiting that patent and can likely benefit. But we'd need to look at the R&D fraction to make sure that how much benefit there is. Income from patents is streamed, so you would identify the income that generates from that patent specifically, and then the reduction in tax associates with that associated profit. The next question I had was, with the definition of what is an R&D claim being very narrow, I'm wondering if the following example would classify as R&D. I work in manufacturing of custom designed conveying equipment unique for each customer. An extensive program is being written to automate the production of engineering design drawings and documents. Would this qualify as R&D? You're right in saying that the criteria are tough. From the information you have there, it is possible. It would depend really on what the advance actually was and if it was easily deducible or not, as I said. Simply needing something new isn't enough in itself. So if your program uses existing code, for example, and just combines it in a different way to get a different outcome, then you likely wouldn't be R&D. But if you've got to write new programs and new code or pull together new processes to make it work, then and you perhaps needed a team of people, it wasn't that one person could do it on their own, then there's certainly a chance that it could be eligible. And the final question that I had was, do R&D tax credits drive investment, or are they just a poor use of ratepayer money? I do think they drive investment and innovation. I personally think what they do best is keep the innovation in the UK rather than people moving offshore with their new ideas, where perhaps the skills are more readily available or cheaper. I think the cash incentive is really good for businesses to help them develop new things, because often cash becomes the barrier to innovation. So I do think it is quite important. And the UK economy then benefits once they've developed that innovation and they've come up with their new invention or whatever it might be they've designed. They then benefit from the future income streams and the tax collection. So I do think it is a good use of money. You'll be pleased to know I have now got to the end, I believe. So I will pass back to Richard.
Just look, thank you, Claire. I saw a question just come in there, which we will follow up for that gentleman for you. But look, thank you. That was 45 minutes of rich content. I mean, there is an enormous amount to cover in that brief. And look, well done for everyone on the webinar. As I said, copies of the slide, copy of the webinar is available, will be available on our website. And importantly, Claire will be available for follow-up questions and discussions. What about should I try? Oh no, there's a question, maybe Claire, see if you can tackle this one now. It's come through,
Yep.
I think, in the Q&A.
The meeting.
Or it's in the meeting chat, actually. If we license unique technology from Australia, could we claim for a capital purchase of that technology? If we license unique technology from Australia, could we claim for a capital purchase of that technology?
Yes, I think is the short answer to that. I think I'd need more detail. It sounds like it's a capital purchase that would probably be eligible either for capital allowances, or we could look at potentially the patent box if you've got the exclusive license. We'd need to see what R&D activity is actually being taken place in the UK to see what that fraction comes out like. But yes, there's certainly something that could be claimed there. That's something we could look at.
Thank you, Claire. Look, again, the presentation will obviously contain Claire's contact details as well. And I would encourage everyone to reach out. I think, I'm going to say it, I think Claire and Alliotts, on behalf of Alliotts, have established some credentials and experience and knowledge in this space, and therefore would encourage you to circle back. So to everyone on the call, my thanks for joining us. This was a very targeted type topic. It was packed with an enormous amount of information, and from here, you have an expert to support you. So my thanks, and enjoy the rest of the day.
Thanks, everyone.